Let's start with the second part of non-funded based credit facility, which includes actually mainly bank guarantee. The first part we have seen on letter of credit. Now you see in India, HDFC is the first bank who has issued electronic bank guarantee. Okay, so now this area has been explored by other banks too, where SBI and all other uh, nationalized and private sector banks they are aggressively exploring. Okay, so now you see the subject is bank guarantee. So in this, what is this actually? It is actually a non-fund based facility. What it means, like it is not a loan where bank is supposed to give some funds on day one, but this is something of sort of future commitment or future obligation where banker may be required to make a financial commitment. Means they have to make some monetary payment to some third party. Okay, so this is nothing but it is only a commitment in future for one of our existing clients. And why we are doing it is like because this is a type of financial service. It helps bank to generate commission. It helps bank to earn interest. Now you see you're getting collateral, hence you're feeling secure, and then you are willing to go forward and give this additional facility to your client. If client is not able to complete their commitments to third party, so whatever compensation or like monetary obligation comes in, that is also predefined. So a bank has to fulfill the same. They have to compensate the same to third party in the case of bank guarantee. Okay, so banker undertake a risk to the amount on the happening of a future contingency, any a situation which may go adverse to one of our client who has undergone a bank guarantee facility with us. So we may be required to make a monetary payment. Okay, but this is clearly defined. Time period is also very clearly mentioned to it. Now, what are the advantages of this particular bank guarantee to the client? You don't need immediate outlay of funds. It is like for a commitment from a bank, you have to give some collateral and some processing fee. That's all. And then this is like you see future contingent deployment of funds. So funds are not actually given to party. It is only on the basis of commitment. How you give commitment is like you take some collaterals. Risk are similar to funded exposure. Means right now maybe you don't have any exposure, but after the completion of the contract period or after the completion of the timeline mentioned in the contract, that is with third party. Now you see if something goes wrong, you have to come into a exposure, funded exposure. So the risk is almost similar. uh, Earning by way of upfront fee commission. Yani whatever you do, your processing fee and your upfront commission is what you're going to get out of it. Then sometimes it involves foreign exchange, so exchange related some commissions may also be a part of your earning as a banker. So what is this going to help you? You see, this helps you in mobilization of funds. Sometimes the security is given in the form of an FD. Sometimes it is given in the form of a collateral, which is removable in nature, like land and building. And you see, this helps you to get strong clientele base. You're facilitating them in their needs, so they will come back when there is a need for bank. Okay, so they are getting something in return for sure. Comparatively easy monitoring. You see why it is easy to monitor a bank guarantee. Why? Because you see you did your documentation. You know which is the other party involved. The other party is very clearly aware about the bank who is doing this service facilitation. So if anything goes there, the other party has an obligation to inform it to bank. So bank is getting the regular updates. They need not to run after anyone. If there is any change, material change in the contract between buyer and seller, you see bank has to be informed. Or in this case, you see if there is a performance guarantee, the other party who is giving a contract to one of our client who has given a performance guarantee, you see we will be updated as and when there is a need. Okay, being an important party to this contract. It costs less to banker. Why? Because we need not to have too much. So it is simply we have to do something into future, and we have already charged this client on day one for our services. Is like a sort of revenue enhancement for banks, and very low chances are there for a default. Why? Because most of the time when you take these contracts from third party, and your clients are taking these contracts from third party, the margins are very well set in. Okay, the timelines are very well set. The party is an expert in that area, hence he is getting a contract. So you see, when so many viability and feasibility tests are being conducted before giving a contract to a party, you see, hence the probability of a default in this case is very less. Now there are two types of instruments mentioned here. One is letter of credit and second is guarantee. They both can be both inland. Inland means local geographical terrain, or it can be into foreign context also. Okay, so guarantee according to Section 126 of Indian Contract Act 1872, guarantee is being defined as a contract to perform the promise or discharge the liability of a third party in case of his default. So bank will be taking this responsibility. Which are the parties involved? It is applicant, it is beneficiary, and it is your guarantor. Guarantor is your bank. Applicant is the person who is like a client to this bank, and he is going to undertake a contract for a third party, which is called as beneficiary. Okay, so this is how it has to be done. It has a very well defined period. It has a definite amount and a very clear purpose. Okay, this needs to be like in line to the terms and condition mentioned in the guarantee contract. Both parties have to follow the same. So inland means within India. If the beneficiary is located in India, you will go with inland. If it is like outside India in a foreign country, so it has to be a foreign guarantee. Now you see here three types of guarantees I mentioned. Financial guarantee is first, performance guarantee is second, and deferred payment guarantee is the third one. You see, financial guarantee means it is usually in case of a government contract. The contract is awarded to a contractor, and there is a security deposit which is required, earnest money deposit. Okay. You see, it is issued especially to excise department or custom duty team. And sometimes when there is a dispute between the government agency and the contractor who is our client, so then in that case maybe these guarantees are invoked means they are initiated and bank has to make a payment for it. These are usually created in order to recover the expenses which has been made by the government agency for undertaking this contract if this contract is not able to be completed as per the terms and conditions. Okay, so performance guarantee is second. It is issued by bank on behalf of their client, whereby banks gives assurance to third party that the client will be able to fulfill the contract as per the terms and conditions. If there is some breach from client's part, then bank is supposed to make a compensation payment to the third party, which is again a clearly defined amount. So it is actually a contractual obligation for a bank. And then deferred payment guarantee means you see here, let's say we buy a machinery which is very heavily costing, and this amount is to be recovered over a period of 5 to 10 years. So for this regular commitment repayment means money is going to come to you on regular intervals. You would ask your counterparty who is the buyer of this machinery, he needs to bring in a bank guarantee, so that bank is giving a guarantee that all installments will be paid on time. In case of a default, then bank has to be made an obligation under obligation, and then they have to pay for the loss. Now there are so many clauses which are associated to bank guarantee. Here there is something called as limitation clause. Limitation clause means to what time period will this guarantee will be activated. You see, it always have a predefined timeline. Okay, here in this case they have mentioned it like minimum claim period to be mentioned in bank guarantee is 1 year. So circular is also mentioned very clearly. This must be a circular from RBI which might have been given to banks, and banks can again draft their sub circulars for their own utilization. Okay, so this is one draft which is showing you how guarantee limitation clause is put in. Notwithstanding anything contained herein above, or liability under this guarantee contract is restricted to an amount. So they are limiting their liability by putting up a specific amount in it with a particular validity period, and we shall release and discharge from all our liabilities here under unless a written claim from the payment under this agreement is lodged to us within these many months. So you see, they are putting up very clear timeline. So if you don't put up your claim within this period, then the document will be expired, and then bank will not be under any obligation to make us compensation. So next is like guarantee confirmation clause. So confirmation clause means the confirmation of the bank guarantee is available with our controlling office. Means they are putting up clear line of offices where you can get it verified whether they are genuine or not. So it is always important that beneficiary, the seller, or the government agency who is giving this contract should be able to get a confirmation, should be able to get a confirmation from the controlling office whether this document is genuine or not. So just to avoid fake or counterfeit guarantee documents into market. Invocation of guarantee means when you like invoke and you are asking for compensation. So you see, when you raise it, the claim, the settlement has to be done very fast without any delay. Okay, branches are not empowered to postpone beyond 3 days from the date of invocation. Means maximum timeline are allowed or grace period allowed is 3 days. Within 3 days, we have to settle it. You see, branch can, if you delay, then you have to pay for compensation for additional delayed period. Okay, sometimes there may be a penalty also. So invocation has to be made by the same authority in whose favor bank guarantee is issued. Let's say it is issued for state government, Punjab, and a particular department, let's say PWD. So PWD Punjab government has to initiate this thing. No other department will be undertaking it on their behalf. Okay. So as per the terms and conditions, it has to be done. Okay, in case of payment, if it is refused, then you see there will be subject matter of court intervention. Precautions are required. And when we do it, you need to have a particular serial number which will be signed by delegates, and it needs to be completed as per the documentation. Thank you.